So many people across the United States are using tax deferred retirement accounts to save for their own retirement. Those are accounts like your company 401k or 403b plan, perhaps an individual retirement account, a traditional IRA, or maybe a SEP or a simple IRA, something to that effect. These are wonderful accounts that have great tax benefits. The drawback, as you might know, is that when it comes time to actually take money out of the accounts when you're in retirement and need that money to pay your living expenses, generally every penny that comes out is going to be taxed to you as income. And for that reason, tax is a topic that just kind of looms over the shoulder of a lot of retirement savers because they're not sure what the tax situation will look like at the time. They know it will be there, it will be present, they have to pay tax on something, but it's just kind of this great unknown. And with that in mind, in today's video, we're going to cover my 4 favorite tax strategies in retirement. We'll cover a variety of things that cover the spectrum of accounts and strategies and that kind of stuff, with the hope that at least one of them will resonate with you that you can put to use in your own retirement plan. The first strategy I want to cover today are Roth conversions. This might not come as much of a surprise to a lot of you, particularly if you've seen a lot of our videos that we've covered in the past. But I wanted to cover it first because it really is a tremendously powerful strategy when used in the right circumstances. So let me set the table for you. Because so much of us are using tax deferred retirement accounts to save for our retirement, this comes with a big tax burden down the road. And the IRS has allowed you to defer taxation on all the money that you've put into these accounts. It's a great deal. They've allowed you to do that because the government does want us to save for our own retirement. That's why we have IRAs and 401ks available to us in the first place. So the money that we put into these accounts generally is all deductible. We don't pay tax on the money that goes into them. But the IRS doesn't allow us to keep the money in there forever. And when we're in retirement, even if we don't need the money for any purpose at all and don't otherwise want to take it out, the government forces us to start taking it out when we're in our mid 70s because they're waiting to tax us on that part of our loot. They've been allowing us to defer taxes for so long. They've been chomping at the bit to tax us on this portion of your wealth. So when you get into your mid 70s, they actually require you to start taking money out. And the math on it is that in the first year that this requirement begins, you take your account balance from your deferred accounts on December 31st of the previous year, you divide it by your life expectancy based on an actuarial table that the IRS gives you. That's the amount that you have to take out in year 1. Now fast forward to year 2. You might have a little bit of growth in the account, even though you had to take some out in year 1 from your distribution. Well, in year 2, oftentimes some investment growth means you have a larger balance in year 2 than you did in year 1. You go through the same exercise, you divide it by your life expectancy that the IRS gives you, but now you're 1 year older. So your life expectancy is more or less 1 year lower. When you divide a larger number by a smaller denominator, you get a larger number. So the purpose of this is as we get older, we're forced to distribute a larger and larger portion of our tax deferred accounts. And unfortunately, that can kick us up into higher tax brackets when we get into our 80s and 90s and beyond. So let's go through an example using some modeling software of how this actually plays out and where the opportunities are. So here's a hypothetical example using some modeling software. You can see that I like to use the hypothetical example of Jerry Seinfeld and Elaine Bennis because I'm a huge Seinfeld fan in general. All we're looking at here is expected cash flow over a retirement time horizon. We're expecting that Jerry and Elaine both want to retire this year when they're 63 years old. And what we're looking at here is a cash flow projection that tells us where cash is coming from and going to. This little red line at the top of our output of our display represents total spending, including taxes. The columns underneath that line show us where the cash is coming from. So at this point, Jerry and Elaine are in their 60s. This yellow color tells us that they're taking money out of their savings accounts to meet their living expenses. Then at some point, we have Social Security that turns on that offsets their need to take money out of the accounts. So we have a portion of the column is now blue, a smaller portion is yellow. But then when they get into their mid 70s, that's when these mandatory distributions kick in. And the height of the columns goes up and up and up and up over the rest of Jerry and Elaine's lives, not because they necessarily need to spend that much more. Yes, we're considering inflation. Yes, their cost of living will go up as a result of inflation over time, but their spending is going up in a dramatic way because, in addition to inflation, they have to pay tax on those substantial distributions, and that is actually putting them in a higher tax bracket. So when we look at the tax situation, they will owe no tax in these years. They were assuming they have enough savings just sitting around to pay their expenses. Then they start Social Security. They start taking money out of their tax deferred accounts. They'll owe some level of tax. And then when when the mandatory distributions kick in, their tax burden will jump. These colorful lines represent the tax brackets as they exist right now. And what you can see is because of that math we were just going over, every year that they get older, they have to distribute a larger portion of their tax deferred accounts. Jerry and Elaine will likely find themselves in higher tax brackets over their later years. The opportunity here is to do what's called a Roth conversion, where you take some of the money in your tax deferred accounts. That could be the 401k, the IRA, any of those other simple IRAs, SEP IRAs, and the like. And you push some or all of the accounts, some or all of the contents of the account into a Roth IRA. Now, when you do that, 100% of the amount that goes from your traditional to your Roth account is considered taxable income. And this is the best way to represent it because these colorful lines show the tax brackets. And what I'm going to instruct the program to do here is convert just enough of their tax deferred money to get us to the top of this blue line, which represents the beginning of the 24% tax bracket. So, what Jerry and Elaine would be doing is paying more tax in these years than they would otherwise have to by virtue of these Roth conversions. But what it also does is it keeps them out of these higher tax brackets when they're older. I'll toggle it on and off again for us. So, if they do nothing, they will not owe income taxes during these years. Again, this is a simplistic assumption. I engineered this to make a point. But they'll find themselves in the 32% bracket starting in 2046 for the rest of their lives. Now, this might be okay for Jerry and Elaine. If their goal here is to kick the can down the road, pay as little in tax now, and they don't think they're going to live into their mid 80s, then perhaps this is a fine strategy, just leaving things as they are. But if we quantify what is the expected amount of cumulative taxation until their age 100, we get a pretty big number, almost 4.5 million they'll have to pay to their federal and state tax authorities. Now, if we do Roth conversions and pay more tax now than we otherwise need to, that means that they'll be out of that 32% tax bracket and will be within either the 22 or 24% brackets over the rest of their lives. And you can see that side by side, this winds up saving them a very substantial amount of money. Now, again, I engineered this scenario to make a point. Most people do not have a profile where they would see this much tax savings by going through a few years of Roth conversions. But it's not that uncommon to see seven figures of tax savings by doing some sound conversions. This is not the right strategy for everybody. Again, you have to live a nice long life in order to realize that these tax benefits yourself, but it makes sense in a lot of situations and is a really powerful maneuver when used appropriately. The second strategy I wanted to cover today is qualified charitable distributions. And this has a lot to do with the fact that a lot fewer people around the country these days are taking the standard deduction instead of itemizing on their tax returns. That has to do with a law that was passed in 2017 called the Tax Cut and Jobs Act. That was Trump's tax changes from his first term. they doubled the standard deduction as part of that piece of legislation. And as you might recall, every year when we file our taxes, we add up all our income and then we take deductions away from it. The amount of that deduction is either the standard deduction that we're all entitled to taking or itemized deductions, which are a sum of other deductions we'll go over here in just a minute. So this year in 2025, the standard deduction for couples, for married people filing jointly, is going to be $30,000 or $15,000 for single filers. So what we do when we file our taxes is we add up all our itemized deductions and just see if our itemized deductions exceed that standard deduction that we're given. If they do, then we add Schedule A to our tax return and itemize our deductions because we get more benefit from it. But if our itemized deductions are less than the standard deduction, then we just skip that and take the standard deduction everyone is entitled to. Now, the typical itemized deductions people have these days are state and local taxes paid up to a limit of $10,000, mortgage interest, which may or may not be relevant to you in retirement. It won't be if you have your house paid off by then, and charitable gifts. So think about that. If you're someone who is going to have your house paid off by the time you retire and you're married and your standard deduction is $30,000, but you're only limited to $10,000 of state and local taxes as an itemized deduction, that means that in order to benefit from charitable giving from a tax perspective, you have to give at least $20,000. Because if your only itemized deductions are state and local taxes that total $10,000, if you give $2,000 to charity in a given year, your total itemized deductions will only be $12,000, still a long ways off from itemizing because the standard deduction is still substantially greater. When we give to charity, it's an itemized deduction, and that's where this strategy comes into play. A qualified charitable distribution is one where you take a distribution from your tax-deferred retirement accounts, most likely your IRA, but instead of instructing your broker to send money to you, you instruct them to send it directly to your charity of choice. And as long as it's a bona fide 501c3 organization, this strategy works. You have to be at least 70 and a half years of age, and you're limited to $100,000 per year per spouse. The benefit here is that if you were to take $2,000 out of your IRA and then give that money to charity, you have $2,000 of distributions you get to pay tax on. You'll get a 1099 for it. You have to pay tax on it. And then a $2,000 charitable deduction as an itemized deduction. But you may or may not benefit from that as an itemized deduction. A qualified charitable distribution means you send the $2,000 directly to charity. And if you do it right, it doesn't even show up as income in the first place, meaning that you take the standard deduction, but the $2,000 that went to charity can still satisfy your mandatory distribution requirement, which we talked about in the Roth conversions, and it doesn't show up as income to you at all. So this is a great benefit. Again, it needs to be used in the right circumstances, and you can't do it before you're 70 and a half years of age. The third type of strategy we're going to talk about today has to do with asset placement or asset location. And the idea here is in our investment portfolios, if we have a diversified and balanced approach, there's a whole bunch of different investments that we want to put in our accounts. And if you're like most people, you probably have a couple different types of accounts with different types of taxation. For example, that tax-deferred 401k and IRA that we're talking about, you've deferred taxation on that money to date. You'll pay tax on every single penny when it comes out of the account. And while your money is in the account and invested, if you have capital gains or interest or dividends that accumulate inside the account, you don't pay tax on any of that. You can trade and buy and sell with impunity. On the other end of the spectrum, we have our Roth accounts where you've paid tax on all the money. You can trade and buy and sell with impunity. You don't pay tax on anything that happens in the account. And when you take it out, that's all tax-free too. Then you have your taxable accounts. A lot of you might have individual accounts, or I should say brokerage investment accounts in your name, maybe held jointly with the spouse in the name of your trust, something to that effect. And in those accounts, You pay tax on every penny of interest and dividend and capital gain that accumulates every single year. At the end of the year, your brokerage firm will send you a 1099. You get to report that information on your tax return and pay tax on it in that year. So the point here is that we should think of our portfolios as a group in the entirety. And if you're someone that has money in more than one type of these three general types of accounts that I just rattled off, there is optimization to be had by parking the more tax efficient stuff in the taxable account that you're going to pay tax on every year, and the less tax efficient stuff in the Roth account that you're not going to pay tax on again. So here's an example. Large cap US stocks are going to produce returns in a couple of different ways. Capital gains, if you buy this group of stocks, large cap US companies, maybe by buying an S&P 500 index fund or something like that, you're buying 500 different companies. And over time, the value of that holding, the value of those companies is probably going to go up. So if you buy it at price number one, and then that holding increases in value and increases to price number two, and you sell it, you get to pay tax on that capital gain and that increase. Now, large cap US stocks will also produce a dividend. Some of the earnings will be returned to shareholders. The earnings from each of the 500 companies will be returned to shareholders in the form of a dividend, and you get that deposited into your account or reinvested back in the fund if that's what you elect. Now, the crux here is that long-term capital gains are taxed at lower levels than interest and short-term capital gains are. Dividends that you receive can be either qualified and taxed at lower rates or non-qualified and taxed at higher rates. And the types of stocks that we buy are more or less likely to have this qualified status and produce returns to us that are taxable at lower levels. So here's an example. Large cap US stocks will pay a dividend. They have an expected return. And it's very, very likely that 100% of those dividends will be qualified and taxed at lower rates. But emerging market stocks that we might also like to include in our portfolios, and by emerging markets, I mean stocks of companies based in less developed economies around the world, they'll also have an expected return that's pretty high. They're a little bit riskier than US stocks, and they have a higher long-term expected return. They also produce dividends, but fewer of those dividends are going to be qualified and taxed at these favorable rates. And then we also have bonds. We might want to put bonds in our portfolio. Bonds have a lower expected return, less volatility long-term, but bonds produce interest, and interest is never taxed at qualified rates. It's always taxed at your ordinary income rate. So if we have a tax-exempt account like a Roth, a taxable account that's in your name or in the name of a trust, and a tax-deferred account like your 401k, if these are the only three things that we want to invest in, we should park the emerging market stocks in your Roth account because they're less tax efficient and are going to grow more long-term than either the US stocks or the bonds. And we know that because historically, emerging market stocks pay less of their dividends as qualified distributions. And the Roth account is the one you're never going to pay tax on again. We should park the bonds in the tax-deferred account because remember, that money is going to have to come out and every penny is going to be considered taxable income. Meanwhile, the bonds, most of their return comes from the interest that accumulates, and that's not very tax efficient. So park that in the account that is taxed when you have to take distributions. The bonds have less tax efficient interest, and they're not going to grow by as much. So when the money does have to come out, the pile is a little bit smaller. The US stocks are the ones that are more tax efficient, and by putting it in the taxable account, you get to enjoy those lower tax rates. Now, if this sounds complex, it's because it is. And if I have a warning about all this, it's that this exercise can get very, very complex very quickly. And if you don't have a fancy piece of software to use to help, we pay for really expensive software to help us with this stuff in our financial planning firm. If you're trying to do it on spreadsheets, I'm just cautioning you that it gets very complex very quickly. And there's a lot to be said about keeping it simple. Now, that being said, the academic studies on this subject will tell you that if you're able to execute asset location perfectly and consistently, it will add maybe 0.25% per year to your after-tax returns on a net basis over a long period of time. The fourth retirement tax strategy we're going to cover today that I'm really, really fond of has to do with health savings accounts. You might be familiar with them, you might not be. We'll go over the details here in a second. But there's a specific long-term strategy I think is really kind of neat that you can use if you have money in one of these kinds of accounts. Now, more people across the country are familiar with FSAs or flex spending accounts than they are HSAs, health savings accounts. Flex spending accounts are more prevalent through workplace benefits. For a lot of people, they're a benefit you can enroll in during open enrollment. And then when that benefit period becomes effective, your employer will take a little bit of money out of your paycheck. It'll go into an account called a flex spending account. You can use that money to pay for your out-of-pocket medical expenses throughout the year. And the beauty is that the money comes out of your paycheck before you pay tax on it. So it's a way to use tax-free money to pay for some of your out-of-pocket costs throughout the year. The catch with these accounts is that you have to use that money in the 12-month cycle that you're in. If you don't, the money goes away and your employer relinquishes it. And that's exactly why you see a lot of people in Costco on December 27th every year buying pallets of Band-Aids and mouthwash and that kind of stuff. Because if they don't use the money, it's going to go away. Health savings accounts are different. To be eligible to contribute to a health savings account, you have to be enrolled in a high deductible health plan that has deductibles and out-of-pocket maximums that meet federal standards, federal thresholds, which change a little bit every single year. If you're enrolled in one of those plans, you're eligible to contribute some money to an HSA. And again, the limits there go up about every single year. This year, it's a little more than $4,000 per person for individuals, a little more than $8,000 for an entire family that's enrolled. The deal with health savings accounts is you don't have to use the money in that year. It carries over into the future. The money that you put in is a deduction on your tax return. You can keep it in there. You can invest the money for long-term growth if you want, and anything that happens inside the account is tax-free. And in the future, when you take money out of the account, as long as it's for a qualified medical expense, it comes out tax-free as well. And all you need is a receipt to substantiate the out-of-pocket expense to make sure you don't pay tax on that distribution. So the benefit here, think in long-term cycles over a couple decades, is this is triple tax advantage. This is about the best deal in the tax code there is. And if you're someone that has access to one of these accounts, the best practice in this long-term strategy I was getting at is put money into these HSAs, invest it, but don't take the money out ever, or at least until you're in retirement. So you put the money into the account, you capture the deduction, you invest it, you get all that tax-free growth, but then as medical expenses come up, you see the doctor, you have copays, whatever, pay those expenses out of pocket and keep the receipts. Because when it comes time to take distributions from the HSA down the road, it needs to be for a qualified medical expense, remember? But it doesn't need to occur, that expense doesn't need to occur in that year. You can reimburse yourself from prior expenses as long as you have the receipt. The only requirement is that the expense occurred after the health savings account was set up initially. So think about this. You put money into the account, you don't pay tax on that. That's a great deal. You can invest the money. It grows long term, tax-free. That's a great deal. And then you can even take the money out. And as long as you have receipts from any period in which the HSA existed, you're not going to pay tax on that distribution either. So if you're someone who's approaching retirement and you have one of these accounts already, oftentimes it can make a lot of sense to pay your medical expenses out of pocket, allow that HSA to grow and just kind of sit there untouched. And either A, you have it available for future medical expenses. Most of us have more medical needs as we get older. Or B, you don't, but you have the receipts and you can take that growth out tax-free later. It's a really great strategy. But again, it takes a little bit of gumption to hang on to your receipts for that period of time. That's it for today's video. I hope you found it helpful. Like everything financial planning, the right strategy, the right maneuver, the right specifics really depend on your own situation. The general theory here with regard to retirement tax planning is that We have a progressive system where the more income we make, the higher rate of tax we pay. And because so many of us are saving in tax deferred accounts like those 401ks, those IRAs we've been talking about, a lot of us have mandatory distributions that push us into higher brackets over time. The game with retirement tax planning is you have the latitude to engineer what years you're paying more or less tax in to some degree. And if you can park your income in those years where you're in the lower brackets, that's generally what's going to lead you to the best long-term outcome. Again, the specifics depend a lot, or the strategy depends a lot on your own specifics and your own personal situation. But in general, that's kind of how it works. So again, I hope it was helpful and you're able to put some of this stuff to use. I will see you again soon.